Well, hello everybody, and welcome to our weekly webinar. My name is Ben Eric Smith. I'm with Real Wealth Network and have been for years, and I'm happy that you're all here. We're going to do a nice, exciting show today talking about insurance, and I'm not being sarcastic. Actually, our guest makes it pretty interesting, especially when looking at insurance through the realm of the investor and all the pitfalls that you could potentially fall into and things that you may be blissfully unaware of, like many things in life. Beth is our guest, and we've had her on before, and she's come to our events and stuff, but really happy that you can be here, and we'll get into all kinds of exciting stuff. There we go. What this is how to find more information on our website. So if you're logged in, then you go over to the left, way over on the left. I know it's hard to see, but it says insurance there, and you just highlight your mouse, float your mouse over insurance. And then the only option is, it's just about to come up. There it is. Over to the right says JB Lloyd and Associates. Just click on that and it'll take you to Beth's contact information. So if at the end of this webinar, we'll have a slide that also says this, but that's how you find it on the website. Once again, just go over to the left under insurance and highlight JB Lloyd and Beth will come up. So advance one more for me, please, Beth.
Okay.
Alrighty, so our presenter, Beth, is, go ahead and you pronounce your last name for me.
Boyso-Coots.
Boyso-Coots, okay, I didn't want to botch it, you know, it's always awkward when that happens. Vice President of Sales, joined JB Lloyd and Associates way back in 2006, specializes in insurance products for banks and real estate investors. And, you know, we're not banks generally, but we are generally real estate investors, so that's what we're here. We're going to talk about master policies, regular policies, rental dwelling policies, what to look for, special versus standard, all that stuff. And what I'd like to just tell everybody is, if you're watching this webinar live, you've got the go-to webinar control panel. If you have any questions, feel free to just type in the question right there. We will absolutely get to all the questions at the end, but I will be scanning it, and if it's appropriate to kind of just interrupt and get that question taken care of right then, we'll do that. So don't be shy, go ahead and enter in any questions you might have based on what Beth is talking about. And go ahead and advance for me one more time, Beth, and I will turn it over to you. Welcome, it's really good to talk to you again.
Thanks, Ben. It's good to talk to you, it's good to see you. Seems like we've all been in our COVID caves for a while.
For sure, yep.
Yeah.
Good deal. So tell us all about, you know, just what got you started in this industry, and then take it away, and we'll go from there.
Sure. So I, like most people, did not grow up thinking I want to be an insurance broker when I grow up. That never entered my mind. But my father started JB Lloyd and Associates back in 1988, and I ended up being pulled into the business and found that I really, really enjoy it. The thing about insurance is that there's always something to learn. It's always interesting. You never know it all. And I love that challenge. And actually, I've been working with you guys at Real Wealth since 2017, I believe. And that's kind of a fun story. I was on an airplane going to an event in Miami, and I was next to this gentleman, and he and I both slept the entire flight. But when we were getting up and, you know, deboarding the plane, we introduced ourselves, and it turned out to be Tim Tim Horvath, or did I say his name correctly? Yeah, the awkward misspelling or mispronunciation of names. But we, as we deplaned, Kathy caught up with us, and we went and got our baggage and realized we were all going to the same place. So we shared a ride to the venue, and the rest is history. We just found that we served the same people, and we had similar goals, you know, in our service to the real estate investors, and we began that began this wonderful relationship. So anyway, yeah, you never know who you'll meet on a plane.
Yeah.
So I got into the business in 2006 and really specialized in insurance for the lending departments of banks, which I still do. during the financial crisis of 2000, I guess it started at the end of 2007 and went through like 2010, a lot of the people who were involved with real estate investing were buying up these large pools of distressed assets from the lenders. And they needed something similar to what I was providing the lenders. And at that time, there was nothing else out there other than the traditional forced place insurance policy that a lender uses. That is how I ended up working. So anyway, the rest, again, is history. And since then, I've been very involved with developing programs and policies that meet the specific needs of the investor, because it was really just nothing. There was nothing out there other than a forced place policy, which is really not the most appropriate thing.
It doesn't sound very good. Forced place policy. It sounds like something you want to avoid.
Yes, exactly. Kind of like COVID. You don't want to be on the receiving end of a forced place policy, and really as an investor, it's not the best fit. And I'll speak more on that in a minute. Okay. I put some statistics together, just not to scare anybody, but if you are investing in multiple properties, these are things you need to be aware of. Natural disasters occur. They occur every year, and the incidence of them has been an upward trend historically. If you look at the last 100 years, that line is moving upward. It is not a downward trend at all. And so I put some statistics together just the last 5 years. As you can see, 2017 was a little higher. That is due to Hurricane Harvey. But it's just really stayed very steady. We've had the fires in California. We've had the hurricanes, we've had the tornadoes, we've had the hail. I moved from the Dallas area to the Austin area of Texas back in 2019. And I put this example here, and some of you may have seen it before, but this is actual hail from a North Texas hailstorm that we got in the North Texas Dallas area. This kind of hail represents millions of dollars of new roofs that happen in Tornado Alley every year, because along with the hail, you usually get the tornado. And so between the two of them, wind and hail, we see significant losses. So I don't miss it. I'll tell you, I had 3 new roofs in 13 years, but I thought you guys might get a kick out of this because it's a real thing.
Just out of curiosity, I mean, why does Dallas have so much more hail than Austin? Does the hills of the hill country in Austin keep hail away somehow?
Well, I like to think so. It's actually different climate zones. Mm-hmm. So I guess, if you're into gardening or any of that stuff, you kind of know about this, but it's a different climate zone. And because of that, Austin just really doesn't get the tornadoes. I guess there are some parts like northeast Austin that get them occasionally. And the hail that we get here is like little pea-sized hail. Right. People complain about it, and I say, oh, that's not hail. That's just not hail. You don't know hail.
Right.
Yeah.
Hail, no.
Yeah, I would say that, but I didn't know if, I could online, The Texas girl, though, it might slip out. Okay, so the next slide here just shows a graph that it really illustrates the upward trend of natural disasters. And again, being touched by one of these things, not to sound negative, but it's not a if, it's a when. So moving on, just gave a little bit more positive natural disaster illustrations for you. The first picture is from Hurricane Harvey. We have many of our clients were impacted by that, and many of them did not have flood insurance. It was areas they said were not in flood zones were flooded, and it was pretty tragic. The second one is an actual picture of a tornado in the Dallas area. It wasn't the one that I experienced when I was flying back for one of my last events pre-COVID, In October of 2019, I was on a plane going to Dallas from Austin. We passed this beautiful cloud formation. I didn't realize at the time it was a pop-up storm and it was a tornado cell. And if y'all heard about that tornado that hit Dallas in 2019, that was it. I got to
Wow.
the hotel literally minutes before it hit. And it was amazing because it was an amazing storm, but there was not any fatalities or injuries, I don't think, just
Hmm.
a lot of property damage.
Yeah.
I was also in California during the Paradise and Chico and um, Lake Shasta, I can't remember that town, fires. So I decided I just don't need to travel anymore. So here we go, next one. So what you need to know. So as investors and as someone who works with investors all the time, I've put together some things that I really feel that you guys need to know about when you're evaluating your policy or when you're evaluating a proposal for a new policy. And so I put these together, and please feel free to, ask any questions, type them in. Ben can put them together and we can address them, at the end of this, or you can contact me and I can go into more detail with you. But the first one is, what is a master policy as opposed to an individual policy? So an individual policy, it's very, just like what it sounds, it's like your homeowner's policy. In the buy and hold real estate investing world, we often call them landlord policies. But it is a single insurance contract that is addressing a single property. That is it. So you aren't adding any other properties to that. It is simply one contract for that property. A master policy, on the other hand, is just like that sounds. It's a policy that once it is set up, you have the ability to add properties to it that you, as an insurance or a real estate investor, have an insurable interest in throughout the policy period. And then you don't have to go through any more applications and underwriting. You do not have to keep up with multiple policies, and you have the ability to add properties online as needed. And then if you sell the property or no longer need the coverage, you can go online and take it off. So it's instant coverage at that point, and you're only paying for what you use. And there's no more underwriting. There's no more keeping track of multiple policies with multiple carriers and multiple expiration dates. So the master policy is a very convenient way for a real estate investor to manage the insurance on multiple properties. So that is the difference there. The next slide is, what is the difference between a real estate investor policy and a forced place policy? So I often get asked, I get calls literally daily, Beth, I was referred to you, I need a forced place policy. And I have to say, it kind of drives me crazy, because a forced place policy or a lender placed policy, while it is also a master policy, that's the same, that's the similarity, and that's it, is very different. It's something a lender uses to place coverage on a property they have lent money on to a borrower, and the borrower has not kept up their insurance on it. So the bank or the lender has to then cover their interest in that property because the borrower is not. With forced place with that type of coverage, a forced place policy coverage, general liability is not covered unless the lender forecloses on the property. So if a real estate investor is using a forced place policy, they're not getting the general liability coverage that they absolutely need. If there's bodily injury or if there's property damage caused from that property, they are wide open. They will have to come out of pocket if there's litigation. On a real estate investor policy, general liability is on every property. The other thing is that on a real estate investor policy, the coverage is typically broad or special, meaning it's a much more comprehensive insurance contract. There is much better coverage, and the rates tend to reflect the fact that it's a lower risk type than a forced place policy. So typically the premiums are far less on a real estate investor policy than they would be on a forced place policy.
Yeah, like a couple times, I've got properties and I've got an escrow account. So the mortgage company supposedly is paying the insurance, but they always wait till the last second. So like I have this one house where every single year I get this foreboding, threatening notice from the insurance company. Hey, this policy is about to expire, and it's like, no, it's because you just haven't gotten the check yet from the waiting till the last minute mortgage company. And so for about 3 years, I kind of like, lurched into gear and tried to connect the two disparate parties. And then I just realized it's going to happen, but what they do is they threaten to, hey, if we don't get your premium, we're going to force you to get I guess it was a forced place policy, but they didn't use that term. They were just like, we'll buy something for you and it's going to cost a fortune. So you better.
And you won't be covered. Only we will be covered.
Right. Well, of course they don't say that, but yeah.
And we're going to add this to your loan.
Right.
Yeah. We actually, we do that type of insurance, and we do send those letters on behalf of our banks. There's 3. It's called the letter cycle, and you get the first one. 2 weeks later, proof isn't shown. You get the second one, and finally you get the third one saying it's done, and here's what you owe us. But it's the CFPB mandates the language in those, and it's all very regulatory now since Dodd-Frank and the financial crisis of the late 2000s. But yeah, don't worry about those. If you've got insurance, they cannot legally do it.
Right. Okay.
So,
all right, moving on.
Moving on. Basic form policy versus a special form policy. This is important when you are evaluating your insurance coverage. If it says basic form policy, typically you will have a lesser premium that will go with it. However, you have much, much more limited coverage. Basic form means that only what is listed on the policy is covered. That is it. Anything that is not listed on the policy is not covered. So typically there are the 5 basic perils that are on a basic form policy. Oftentimes you'll see it endorsed for 1 or 2 more, but that is it. Special form policy, on the other hand, is the opposite. Everything is covered unless it is specifically excluded in writing. This is a much more broad contract, gives you much better coverage. What I have found in working with investors, because I work with, there's a lot of different types of real estate investors, and with the buy and hold investors, and of course you can't blanket this. I mean, you can't say everything is one way, but special form policy tends to be the best option for buy and hold investor. You're looking at the long game. You're looking at this investment for the long term. You're not looking to buy it, fix and flip it, get out of it and get your profit. Or you're not looking at a distressed asset like a note investor would be, where you just want to cover your minimal investment in it and call it a day. You're looking to keep this property up, keep it nice, and have it increase in value, gain the equity, pay off the loan, and build wealth. A special form policy is going to protect that asset much better than a basic form policy. Of course, you will see a higher premium with special form policy, but unless you've got a bucket of money set aside for the event of a loss, you're probably going to be better off with the special.
Okay, so real quick question on this right here. I'm familiar with the differences because I've gone through this process, but if you just pick up the phone, you buy a house in a new area and you call your local, Allstate or State Farm agent, hey, I need a rental dwelling, blah, 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 at this 123 Main Street. They come up with a policy and they give you a quote. Generally speaking, is it going to be, do most insurance agents default to basic form or special form? Because I bet most people don't even know and they just kind of are assuming.
Yes. Well, I would like to say that they do, but I do a lot of comparisons for people and evaluations, and I see things all over the page.
Okay.
Even from the same investor, they might send over 20 different deck pages, and I'm looking at 20 different types of, combinations of things. It's crazy. So it's definitely important to know these two terms so that
Mhm.
you can look at your policy and know which one you have.
And it's going to either use the word basic or the word special somewhere.
Yes,
I mean, they're not couching it in cutesy language. It says that somewhere.
yes. Now, sometimes the quotes don't. They should, but they don't always. But on the policy, it will.
Or the declarations page, it
Yes.
will. Okay.
Yeah.
All right. And before you move on, Beth, I do have a couple master policy questions that just
Sure.
popped up. Okay. So a couple questions on geography. Can a master policy cover properties in, say, 8 different states, or do you have to get a different master policy per state?
Yes, it can cover it. The different carriers have some different underwriting guidelines on that. But
Mhm.
to answer the question, yes, it can. I've got clients who are all over the United States, and they
Okay.
will cover it all on one master policy.
And how does it work if somebody has a bunch of properties, presumably in different states, but that's not really the gist of the question. If the properties are owned or titled in LLCs, different LLCs, can you get the master policy in your name, but you've got 10 different properties with 6 different LLCs? Does that complicate things, or is that
No,
okay?
no. In fact, we have a slide on that, but
Ah, okay.
to just answer it now, that is very common. I would say the majority of the people we work with have at least 2 LLCs, oftentimes many more than that, and they can all be added as additional named insureds to a master policy. Um, I would just say that it's important to talk with an accountant and an attorney to make sure that all that's set up the right way. But from our perspective, we don't care. As long
Okay.
as it's the same person, insurable interest, that's what we care about.
And can your primary residence be part of the master policy?
No, no,
Okay.
not on a real estate investor policy. It cannot.
Got it. Okay. So your primary residence has to be different. All right. I think there was one other master policy related question here. I'm scanning really quickly. Oh, if somebody only has 2 properties, would it make sense to go through the hoops of getting a master policy, or is that just kind of overkill?
Well, okay, that's a good question because most of my carriers like to see 3 to underwrite on.
Okay.
That being said, not all of them. I have some carriers that will do it for 1.
Mm-hmm.
As far as that goes, for the investor, I would look at it this way. If they're planning to grow quickly and they have a plan, an aggressive plan, and they know they're going to have more than the 2 pretty quickly, sometimes it does make sense. It's
Right.
sort of case by case basis though, and that's
Okay.
something I have conversations with people pretty frequently. So I would
Got it.
say to know for sure the specifics, have that person call me.
Okay. Gotcha. I've got a lot of umbrella questions, but we'll get to those because I'm sure that's coming up.
That is, well, I actually no, it's not, but let's talk about that. I did not include that, but that's a good topic and we need to address it.
Okay.
So,
Well, let's keep rolling, and I'll remember, and we'll bring up umbrella at a certain point soon.
perfect. Okay. So the next one here, settlements. We have replacement cost settlements and we have actual cash value settlements. The difference is a replacement cost is replacing the damaged item with something of like quality and value. An actual cash value settlement, they take that replacement cost and then they deduct depreciation. The depreciation is based on the item's condition and age at the time of loss. Obviously, that can vary widely, but basically, actual cash value is a diminished settlement. So oftentimes, you'll see that reflected in the premium as well. So if you're, a good real life example would be, I get calls about things like this pretty frequently, but one was a guy had a policy and he thought, oh, I have insurance, I'm in good shape. Well, then he needed a new roof. The settlement, that first of all, the policy itself was a basic form policy and the settlement was actual cash value. and there was co-insurance, which we'll get into later. At the end of the day, for the $22,000 what needed for the roof, he got, I think, a little less than $8,000, and he was very upset. Had he, taken some time to look at really read the policy, and I know it's boring, but then, have questions and a discussion about what was actually covered, he probably could have avoided that pitfall. But as it ended up, he got a very small settlement for this expensive roof. So
Right.
actual cash value can be kind of sneaky.
Mm-hmm.
So it's definitely something you need to know what it means and how that applies to you and how that will affect your claim.
So the two key things that we've learned so far: look at your policy, make sure it's special, not basic, and make sure it's replacement cost, not actual cash value. So the key
Yes.
phrase is special, good; replacement cost, good.
Good.
Okay.
Basic, not so good. Actual cash value, not so good. Now, that brings me to the next one, which is deductibles and limits and risk tolerance. So these kind of go together. I'm going to start with risk tolerance. Regarding what we were talking about before, basically, your risk tolerance is how much you are willing to come out of pocket in the event of a loss. Are you okay with saving money up front and coming out of pocket more at the time of loss? And are you strategizing and managing your risk in such a way that you're okay with that? You're basically reallocating those funds that would have gone to premium up front to the event of a loss. And maybe, reinvesting them or, using them for something else that generates revenue. This is what all this risk tolerance talk is about. If you're okay with these things, you might want a larger deductible. You might want to go with an actual cash value settlement. You may want to go with basic form. You want just the basics because to a varying degree, of course, that you have a plan. Most of us don't. My good example is escrow, which doesn't seem like it'd be connected to this insurance talk, but it is. Just follow me here. So my husband is very good at planning. He's very good at having a bucket of money set aside for the rainy day or, taxes and insurance every year that comes up on our house. And he would be just fine not having escrow. I, on the other hand, will see that bucket of money and I will go buy shoes. I mean, this is just something I know about myself. That is my risk tolerance. I'm going to buy shoes. I'm not going to save that money for taxes and insurance. You better take it out now because otherwise I'm going to have new shoes. So that, guys can take a look at that like something else, like, I don't know, guns. Guys like guns or football or, whatever. But that's what it's about. Are you disciplined enough or are you going to go buy your shoes and your guns? So a deductible, you can raise the deductible and accordingly the premium goes down because you are effectively self-insuring to a higher degree and saying, hey, I have a higher risk tolerance. Limits, same thing. You may say, well, on the general liability, I'm okay with a lower limit because if I get sued, I will simply self-insure that extra portion of legal costs and defense and whatnot. This is actually a really good place to mention umbrella policies.
Okay.
So typically in a master policy, and even in an individual policy, there's going to be two parts of it. There's going to be the property part, and that's going to cover, a tornado or fire or damage to the property itself, hail damage, the new roof. And then there's the general liability side. That's going to cover the insured if they become legally obligated to pay damages for bodily injury or for property damage. They have a tree on their property, it falls over and knocks a hole in their neighbor's tree. They're responsible for that legally, and that would trigger the general liability coverage. So these policies have those two parts to them. The limits on general liability can be very widely varied. Typically on a landlord policy, an individual landlord policy, the limits for general liability are around $300,000 to $500,000. On a master policy, it's typically $1 million per occurrence, 2 million aggregate per property per year. A lot of people nowadays are putting umbrella policies over the underlying master policy or individual policies. So what that does is that raises those limits. For example, if we're using the master policy with the 2 million aggregate, once they reach that limit, then the excess umbrella policy would kick in and take them to whatever amount that they have chosen. Seems like a sweet spot is 3 million. So the umbrella policy would give them a total of 5 million with the two policies together. Umbrellas are underwritten based on the underlying policy. So if for some reason the insured canceled that underlying policy, the umbrella would also then be null and void. But it is something many people are looking at and doing nowadays. I don't know if y'all did a podcast or somebody did a podcast, but I'll tell you what, I get calls about this all the time, and we didn't used to. So it's something to look at. I think the biggest question is, what do I have to lose if I get sued? If you have more to lose, an umbrella might be something that you ought to look at.
Mm-hmm.
So do you have any questions regarding
Well, yeah, let's see if there's any specific umbrella things. Like I have an umbrella policy, and the underlying limits of each individual policy have to have $300,000 liability on each individual house, and then the umbrella will kick in if that ever gets exhausted. So let's see, why would you get an umbrella instead of just upping your liability limits on the master policy?
The reason is because carriers all have their own limits, and they're not going to go above a certain amount.
Okay.
So that's kind of one of those things that they determine, and we don't have much say in.
Right. Okay. I know there was another umbrella policy here. Okay. This Joe asks, how well can an umbrella insurance policy substitute for an LLC as a legal liability strategy? In other words, instead of having all your properties in LLCs, so that your liability is limited to each LLC, would it make sense to just not do that, have the properties in your personal name, and then just get a big umbrella over everything?
So I'm not an attorney. That would be a question for a real estate attorney. So I'm probably not the person to ask that of. However, I have seen it argued both ways.
Mm-hmm.
I will put it that way, but that would be a question for an attorney.
Right. I've seen it argued both ways too, and the sad thing is it makes sense both ways.
Both ways, yeah. Again, we go back to risk tolerance.
Mm-hmm.
I
Right.
think that's, what is your risk tolerance? You have no risk tolerance, get it all. You're a little bit more risky,
Yeah.
talk to your attorney.
Right. Yeah. Okay. Let's see. This one we
do we have more
answered.
questions? I'll go back.
No, I think we should keep moving on. I think that was it for umbrellas for now.
Okay, so coinsurance. I'm not going to spend a lot of time on this other than to address it and what it is. This is something I am very happy to have deep conversations with if people have questions and want to call me. But in a nutshell, a master policy has, all of them have coinsurance clauses. What that means is if the investor, because the investor is determining how much coverage to put on each property, it's up to them. If the investor underinsures a property, meaning that they insure it for less than 90% of replacement cost, then at the time of a loss, coinsurance will kick in. It's called a coinsurance penalty or a coinsurance clause. What that means is that the settlement will be reduced by the same percentage of deficiency that the investor is beneath replacement cost. Does that make sense? So if you are covering your property for 50% below replacement cost, the way the formula works, it's a mathematical formula, but essentially at the time of a loss, your settlement will be reduced by roughly the same amount.
Okay.
So If your property, if the replacement cost is 100,000, you have to, in order to avoid coinsurance, be covering it for 90,000.
Right.
If you cover it for 45,000 instead, at the time of a loss, let's say there's a total loss, after the deductible, your settlement is going to be reduced by the same, it works out about right. And of course, I don't have the formula in front of me, but it's reduced by about the same percentage of deficiency. So it'll be about 50% less deductible.
Mm-hmm.
I know that's a lot of words. It's a lot of insurancees. I have probably lost about half of the listeners here. Just know this. It's important to know what it is. It's important to know how it affects a claim. It's not necessarily a bad thing if utilized smartly and with a particular goal. And I say this mostly for note investors, not so much for buy and hold. But if you guys ever want to have a conversation about it, feel free to call me.
Okay. Yeah, I mean, somebody actually asks, are you open to reviewing our current policies in place and making recommendations?
Oh, yeah. I do that all the time. Now,
right.
It's something that, like, if you send it to me, it might take me a few days.
Sure.
But yeah, no, I do that a lot, and I'm happy to do it.
And here's the question. Do all policies have coinsurance?
No.
No. Okay. And then what is the best way to determine the correct insurance value for coverage to avoid coinsurance? Because one thing that I've noticed is, you know, you ask your local Allstate agent, you buy a house in a town that, you know, you like it, but you're not familiar with that town necessarily and how much things cost. And you go, hey, Mr. Allstate agent that I just found by doing a Google search, I need insurance on this 123 Post Avenue property I just bought. And they just, they come up with a thing and you're like, gee, I paid, I paid X for it, but they come up with a number.
Yes.
And
okay.
Sometimes seems like that number's a lot higher than it probably needs to be, Yeah. So, I mean, if I'm really looking at things, I'll lower that number. I'm like, no, I mean, it's a replacement cost property. I know that it's going to cost probably about 100,000 if it burns to the ground, but yet I'm paying for 160,000 of insurance. Why is that? Can you lower it down just to save me some money? And then they do.
They probably won't. Well, if they do, they'll probably put coinsurance in there. It modifies things. So let me first start by saying that replacement cost and market value are two different things.
Okay.
Replacement cost is the cost to rebuild or repair based on the supplies and labor. And it does vary some from market to market.
Mm-hmm.
Market value is obviously the price per square foot as dictated by the recent sales in a certain area.
Right.
So two different things.
Yep.
Companies like Allstate, State Farm, these national insurers will use a valuation tool called Marshall Swift, and that's where they get their replacement cost. The niche that I work in, the carriers dictate it because they're in all 50 states. They just say, they don't get it too far into what that particular region's replacement cost is. What they say is, okay, well, for our purposes, $100 per square foot is our replacement cost, which is fine and good. But some of my investors, especially the buy and hold folks, will be in certain markets and they'll say, hey, where I am, that is way too low. And so then we have to do some investigation to find out a better replacement cost for them so that they're adequately covered. Then on the other hand, some of my folks that are especially doing like the note investing and the contract for deeds, they'll say, hey, wait a minute, that is way too high. I paid $25,000 for this property in Indiana, and I'm not gonna, pay the premium on $160,000 for replacement cost. I'm like, okay, well, let's do the math. But if you cover it just for what you're interested in, this is what it's going to look like in a total loss scenario. You'll get this much. If you cover it for replacement cost, this is what you're going to get. And here's the differences in the premium. Now you can make a decision based on the math and do what makes sense for you. So it's not an easy answer, but it is something that I do feel it's good to have ongoing conversation with specific examples when people come across the need to talk about it.
Right. Yep.
So,
all right.
And I probably confused everybody now, but again, just let us know if you have questions. I'm happy to answer them. All right, so moving on, past co-insurance, the bear, the elephant in the room. All right, claims made versus occurrence. So claims made policy, that means that if a claim happens, it will be paid if it happens during the policy period. If later on people come back and say, hey, this happened, but it happened during the time that this policy was in place and that policy is no longer in place, that claim will not be paid. Does it make sense? Sort of?
Yeah, I think
Okay.
so.
So let's say you've got a tenant, they are made sick from some bug spray you used, and it's during the policy you have with me. And then you change the policy to Allstate, but they don't tell you that they were made sick by this until after you changed it to the Allstate policy. Well, that's too bad. There will be no coverage for that. So the opposite is true with occurrence. With occurrence, that same tenant that got sick from the bug spray, even though you're not with this particular policy anymore, that policy will still be triggered and will still pay that claim. This is important to know. I had one client who bought a property sight unseen, and then I guess he went with the local agent, and then we moved it on over to ours. Turns out there was some type of claim. I think it was a tree. I think that's my tree example, actually. And it had happened during the previous policy, and it was a claims made policy. And so he ended up having to pay out of pocket for that settlement because he no longer had that policy in place. So it's good to know which one you have. Do you have claims made policy or do you have an occurrence policy? Obviously, occurrence is going to be better because if something happens after that policy has expired and is no longer in force, it will still be triggered and that claim will still be paid.
Got it. All righty.
Okay, moving on.
Moving on.
How do LLCs affect insurance policies? So I think we've already addressed this, but again, from an insurance standpoint, we don't care. As long as the insured has an insurable interest in all of the properties and all of the LLCs. So as long as there's that insurable interest, we can add as many as needed to a policy. How, in terms of how that affects, the legalities and whatnot, that would be a question for accountants and lawyers.
Yeah, no, you say you don't care, but some insurance companies do. I mean, I don't know. I have like a few. Say that again?
Not any of the ones I work with.
Okay. Because yeah, I've got LLCs and properties in LLCs, and it doesn't seem to be an issue usually. State Farm or whoever, just okay, no problem. We'll just change the name.
Yeah. So what I deal with mostly is the master policies. So with us, we just add the LLCs as additional named insureds. And then on the online system, the insured can designate when they enter a property which LLC that is under. So when they run the reports, that LLC will be listed next to that property. So from a legal standpoint, from insurance, it's fine. It does, as long as there's the insurable interest. I have some clients who will set things up under their personal name and then add all the LLCs as additional named insureds. I have some who will have like a trust and then add the LLCs. I have some that will separate it out. So they have 2 different or 3 policies, with under different LLCs. So I guess the best way to find out the best way to structure those things to make sure that you have the most protection possible is to talk to an attorney.
Okay. No problem. Okay. So Dee Dee actually asked a really good question. Let's say I have 3 properties on a master policy. One has a claim. I expect the entire policy to increase. So what she's essentially asking is, will the entire, is she able to see the individual costs of each of the 3 policies in her example? How much property A costs, how much B costs, how much C costs per year for insurance, A, B, and C added up to here's how much my master policy, or is it just you get one number every year?
So with the carriers I work with, what we do is we will give most of our clients, first of all, choose or monthly billing unless they're escrowed.
Mhm.
So each month they'll get a report that lists each of the properties and shows the premium for that month next to it, and then the total at the bottom.
Okay.
Yeah.
So each property's premiums is in fact itemized so that one can attribute separate premiums to each property.
Yes.
Okay. Good.
And then addressing the claim situation with master policies, because the spread of risk is different than an individual policy, typically one claim, even two, is not going to cause an increase in premiums at renewal.
Right.
I had a client who had 27 new roofs because of a hailstorm in Texas once, and they did not increase his premiums at renewal, which was pretty amazing.
Yeah.
But that what did happen with that one, to go back to the whole thing about underinsuring a property, he intentionally chose to underinsure, so his settlement was less because coinsurance kicked in. So that's an example of when if you have to get that many new roofs, you definitely
Right.
don't want to come out of pocket too much.
Okay, here's a quick, I'm just going to slip this one in. How can you find out, this is back to that claims made or occurrence thing you were talking about. How can you find out whether your current policy falls under claims made or under occurrence? Will that be clearly listed on the deck page, just like the?
Yes, it should be, yes.
Okay.
And if it's not, it will be within the body of the policy itself.
Okay.
But they're all a little bit different, but usually it will be on the deck page.
Okay.
And it's something, when you're shopping insurance, to ask about as well.
Got it. Okay. Let's move on here.
I just put this in because I love it, first of all. All of these things can result in a claim on a property, but it's fun because in Texas, especially North Texas, we would get this all in one day. So I thought I will add this because I'm still celebrating the fact that I'm not in North Texas. And that is that.
All right.
So,
okay.
Questions?
Yes, and we do have quite a few here. Maybe just because we spent so much time on master policies, could you reiterate one more time what the benefit of having a master policy as opposed to individuals? Just kind of recap that again for people who may have missed it.
Sure. So for investors, a master policy enables the investor to have all of their insurance on multiple properties in one place. And they don't have to go through the application process or the underwriting process when they add properties throughout the annual policy period. They have standardized coverage. So it'd be like a special form policy with replacement cost, with a set deductible per loss. And then they have set rates, which is typically a dollar amount per $100 of insurance that they purchase. So they're really in control of it. It's all in one space, as opposed to managing, let's say 20 different policies with 20 different carriers, 20 different expiration dates, 20 different coverage forms, and trying to keep up with that. It's one less thing. Yep. And in most cases, it's going to be cost effective as well.
Right. So back to that special versus basic, is a master policy either a special or basic?
Yes.
Okay.
You can get either or, and it depends on the person's needs. We like to evaluate each person specifically, but I will say in general, buy and hold folks tend to be better off with the special form.
Right.
Cost policy.
I remember when I had this looked at, this was a couple of years ago, 4 years ago, and it was a master policy situation, and it all came back as special, except there was one property. It was actually in Pittsburgh where they wouldn't, whoever they was, they wouldn't do a special policy. So I had to go with basic.
I'm not going to say it, but there's there's a company out there that has some very interesting underwriting ideas. It's unusual, but there's one that will do that. Yeah.
Right. So it's like I would have had like a mixed match thing. They're all special except for this one, redheaded stepchild property over here that just has the basic.
You're like, you're making Pittsburgh feel bad. Yeah. But it's also, kind of counterintuitive to why you get a master policy. You want to set it and forget it. And
Right.
then with my own clients, I like to say, you need to be an expert in real estate investing. Let's work together. I can be your expert in the insurance part of it. Build
Right.
a team. Have folks like Real Wealth on your team. Have folks, whether me or somebody else that knows this business. It is a niche. Have somebody on your team. Have your attorney on your team. Have your real estate agent. Get your team together. It's much easier if you don't have to wear 10 hats.
Right. Yep. All right. Well, here's a question. I'm going to read it verbatim because I'll botch it if I don't. And this is kind of is there a way to research how well various underwriters pay out on claims? Some insurance companies cover all claims in disaster areas, i.e. Hurricane Zeta, which hit Atlanta last year, but other insurance companies try to avoid covering all claims. So how do we compare a master policy underwriter to individual policy companies such as State Farm and Farmers? Or can we?
Best.
Say it again.
AM Best and Standard & Poor's are two of the insurance company rating entities that rate insurance carriers on their financial liquidity and strength, their claim payment history and ability, their insurance forms themselves, all of these things. I would never go with a carrier that is rated A- or less. I would always go with somebody A- or above. Anything less than A- I would avoid.
Got it. Okay. All right, we took this one. Let's see. A lot of questions here. Okay, what is your company? We'll get to that at the end. I have heard that carriers will refuse coverage if the owner is at fault for an issue. For example, if an unlicensed electrician does work incorrectly, resulting in a fire, coverage can be refused. Is this the case for all types of policies?
No, it would have to be spelled out in the policy for that to be an exclusion.
Right.
Yeah, I mean, they have to spell that out, else otherwise you can fight that and successfully.
Okay. Debbie says it's still not clear how to know what replacement cost to use when insuring a property.
So again, that would go back to your specific carrier that you're with. And again, this is if you're with a master policy. I tell my clients in general, because again, this is something that really warrants more conversation. If you're with one of my carriers that we use a lot, the replacement cost is $100 a square foot. That's what they dictate. Now, certain regions of the country are more. That's when we have to have conversation because it's not, it's not going to just appear. And you don't want to be underinsured. So, like for Dallas, I have some investors who invest heavily in Dallas, and we have found that in Dallas, the replacement cost is $125 a square foot. So that's what they do. I have some folks that invest heavily in Southern California. The replacement cost there is really it varies, but from what we have found, it's between $150 and up to $400 per square foot. So it just depends on the region. And again, with my clients, I have ongoing conversations with it about that. You can call local agents in certain regions to find out. You can do some research on the web, but if you have specific questions, there's various ways to find it. It's not just a pat answer that I can give you.
Right. Okay. All right. Couple easy ones. Do you guys issue flood policies?
Yes.
Okay.
We have, what we do is we have a Lloyd's policy that we use. And quite frankly, what I tell people is, hey, let's put it in place, but you know what, shop it before you go with us, because you can probably find it cheaper if you're not going through the Lloyd's policy.
Mm-hmm.
But if you need it in a pinch, we can do it right away.
Does replacement cost include code upgrades?
Cost of construction increases. On some of the policies it does, and others it doesn't.
Okay, so it
On
depends.
my favorite carrier, yes, it does. So, but it
Right.
depends.
Okay. Do you cover commercial real estate?
So on the master policy, no. They will cover up to 4 units in a residential property. Anything 5 and above has to be separately underwritten, and oftentimes they will grandfather in 1 or 2 of those if it's less than, like, say 10 units. For commercial properties, what we tend to do is we'll ask if the insured has a master policy, we'll ask, but oftentimes we'll go out and get that quoted separately and get that, you know, as an individual policy.
Got it. Okay, here's another good Rory question. Are there any locations or types of properties that cannot be added to the typical master policy? For example, can coastal Florida homes be added and covered for hurricanes? Also, can homes rented to commercial businesses, such as a group home operator, be added?
That's a great question. So Florida, yes, we can cover Florida. However, Florida is always, always, always more expensive. So I tell people, if they are investing only in Florida, let's price it out and see what we can do, but then go to the local Florida agents and see if you can do better.
Mm-hmm.
Often they can, however, lately they haven't been able to, as evidenced by my week, and I won't go into it, but let me just say it was a Florida situation.
Right.
So yes, we can do it, but yes, it is more expensive. As far as commercial properties for like group homes and whatnot, we can do it, but oftentimes it depends on what type of commercial residential property it is.
Mm-hmm.
We have to look at each specific situation, and at times we have to go and get those quoted separately.
Okay. Can properties held in my IRA be included in the master policy?
They can, but from what I understand, again, not an attorney, there cannot be commingling if properties are being purchased by an IRA. So you would want to get legal advice on the best way to do that. From our standpoint, yes, we can do it. We have done it, and we have no problem with it. You just want to make sure that you are in compliance with any legal regulations and whatnot. So sometimes clients will like carve out and have a separate policy for those properties that are IRA.
Okay. Can I use a master policy for condos?
Yes.
Sure.
It covers studs in only on those, but yes.
Right, studs in. All right. Oh, this is interesting. My policy says that personal and advanced injury is excluded. What does that mean? Does that mean it doesn't cover, say, a tenant slip and fall situation?
That's interesting verbiage. Personal, I would take to mean as like the insured, if they are hurt on the property. Advanced injury, I would want some clarification on that from the carrier, because that's very odd wording. I have not seen that.
Right. Okay.
If somebody is maimed to where they can't walk, are they excluding that? I mean, that's very vague.
Yeah, that is vague.
So you're only covering a skinned knee? I mean, what?
Yeah.
What does that mean? Yeah, I would definitely ask the carrier.
Okay. And just to let everyone know, there's a question here. Can we follow up with Beth for more questions? Absolutely. I mean, there's a couple slides and we're hitting the hour mark, so we're gonna have to wrap up here in a second. But go ahead.
I guess I didn't bore y'all too much, hopefully.
No, you did not. Go ahead and advance to the next, I believe the next slide might have your contact. There it is. So let's just leave that up. I'll take a few more questions, but it's an hour. So if anybody has to run, we will archive this webinar. It'll be on the website under insurance, which we showed you how to find that earlier in the slides. And there's Beth's email and her contact phone number. which is probably more helpful than the word questions, to leave that on while we take the questions. So let's
Sure.
see. How do you insure on non-investment properties such as primary residence and automobile?
So
It wouldn't
that
be
is
under the
actually,
master, right?
well, what?
It wouldn't be under the master
No,
policy.
no. And so that type of insurance is called personal lines insurance. And that is not something that I do. I don't have carriers for it. I have no expertise in it. You do
Okay.
not want insuring your automobile in your house because,
Okay. All right. Okay, here's a question. How is the master policy paid if the usual payments come from escrow? So if somebody has 10 houses, 10 separate escrows, the insurance is paid every month. How could they get a master policy in that situation?
well, oftentimes if it's paid through escrow, the lender wants it paid annually or will pay it annually. And what we do then is we just invoice the lender. We work with lenders very closely
Okay.
every day.
All righty. Okay. I think a lot of these questions are kind of redundant here. Oh boy, no, I'm not going to get into that. Question: property managers require that they are named insured sometimes. Please explain what this means and any pro or cons to doing this. With the master policy, any issues with naming different property managers for each property?
Oh, no, that's very common. So on a master policy, like I mentioned, there's an online portal where properties are added, changes can be made, properties can be deleted. There's also a place on there where additional mortgagees can be added. That is typically the lender that is connected with that specific property and a property manager and or depending, often it's both, sometimes it's one or the other. Then you can generate an evidence of insurance that will be, it's the same as a declarations page, but it has that property's address on it, the limit of insurance, the limit on general liability, the premium, the policy period, basically when you added it and when it expires, and then it will show the additional mortgagee, the lender and or property manager, and that is what you give to those folks.
Right. Okay.
Yeah. Because you don't want to add the property manager and the lender to the entire master policy because they may not have the insurable interest in any other properties. So we give them the ability to do it specifically.
Okay, and Leah asks, do most investors save money with a master policy? Is there a common crossover in terms of number of homes when it becomes almost always more advantageous?
Yes, usually there's money savings. But we like to do the comparison just to make sure because we don't want, it does us no good to lead somebody in a direction where they're paying more money.
Right. I mean, I can say, speaking for myself, I did this once again, it's 7 years ago, but I went through the whole exercise, and at the time, I had a lot of properties in Ohio and a lot of properties in Florida. The Florida ones were like 70% more than I was currently paying. And the Ohio properties were less, not 70% less, but they were less. So in the end, it didn't make sense for me with my situation. I'm like, well, no, but it was really varied depending seemingly on geography.
I remember yours. Yours was extreme too.
Yeah.
Florida is always the one to look really carefully at.
Right.
Elsewhere in the country, I would say 9 times out of 10, there's a money savings with the master policy if you've got 3 or more properties.
Right.
Florida, again, warrants a deeper dive.
Right. Right. Okay. All righty. When properties are named in a trust, should additional insured list the trust and then separately the named trustees?
No.
Nah. Okay.
You don't have to do that.
Good. All righty. Okay. I think, and it says here, I understand you are a broker. What are some of the insurance companies offering master policies? I mean, can you, does like Farmers and Allstate, do they have master policies, or is it more like the bigger?
No, Great America. Okay, I'll tell you the ones I work with because I'm very picky, and So I work with Great American. I work with American National. I work with Lloyd's London. Actually, we own our own syndicate in Lloyd's, so we have a lot of flexibility there if we have to do something in a pinch. They're not my first choice though. And Proctor Financial. So
Okay.
those are the ones. And I'm always looking at new carriers that are getting into this space. But again, I'm very picky, and I'm not just bringing on carriers because they've decided to try their hand at real estate investor insurance.
Yeah, exactly.
It
Exactly.
does nobody any good.
Yeah, no, you don't want to be the test case while they kind of figure things out and try out their new industry. All right. Well, okay, that pretty much wraps it up. The remaining questions we have, we've already covered, or they're just too darn specific to get into here. So if you need to talk to Beth, by all means, there's her email, there's her phone number. Reach out anytime. And this webinar will be archived, and we explained how to get to it. I think there's another slide after this, so go ahead and fast forward to the next one. And yes, okay, for more generic real estate investing questions, you should always, contact us. We don't want 250,000 people calling Beth with all these kind of general stuff. Your investment counselor, I being one of them, and there's Joe, Aristotle, and Leah, whoever you're assigned to will be able to answer some of these, and then we can refer you to Beth when and if appropriate. And more investor resources are also at investor.realwealth.com. A lot of times there's kind of a backdoor way of finding these things. Up in the search queue, if you type in insurance, then a lot of times any webinars that have this as a topic, or any of Kathy's podcasts that she's done. I mean, she's had you on a podcast a couple of years ago. I remember I was listening to it as I was driving through Texas. Ironically, why we remember these things, I don't know. But there's all kinds of stuff on insurance that you can find on our website. All right, go ahead and advance if you could, Beth.
Ben, I still get calls about that podcast. It is
Yeah.
still out there.
Yeah. A lot of times these podcasts and these webinars, we have the number of people that are watching it live that have been asking the questions, but it lives on for months and in many cases years, because it's still there. We'll replace it at a certain point, but until that time, it lives on. All right, everybody. Well, we've gone over a little bit, but I think that was really good. We've got a lot of people thanking us for everything. So thank you all for listening, and thank you, Beth. Good job. Well done.
Thank you. It's good to see you. Okay, bye-bye.
See everybody. We're going to do it again next week. Thanks so much for tuning in. We'll talk again. Bye-bye.